average for developing countries last year of 1.5%. And that, I think, does show the resilience of Pakistan's economy, particularly its agriculture. The question then is, can we now move from this kind of stagnation, recessionary situation, focused on stabilization, to a situation where we can focus on recovery and growth now that we have stabilized? The answer is yes, we can, but there are some very serious downside risks. Government has, in fact, taken a somewhat more of an expansionary posture this year. The budget for the current fiscal year does not involve any further deficit reduction. It stays more or less at 5% of the GDP. Very importantly, an ambitious and a very sizable increase in the public sector development program is proposed of over 250 billion rupees, representing growth of almost 70%. Significant tax breaks have been announced for important industries like cement and automobiles, and we are already beginning to see the positive impact of that. An aggressive textile policy has been announced with a number of incentives, some of which have yet to be put in operation. And the State Bank has gone ahead with some reduction in the policy rate of about 200 basis points, although maybe there is a feeling in the private sector that we ought to do more, particularly in light of the big decline in the rate of inflation. So can we say now, has the recovery process commenced? Are we in a post-recessionary mode? As I said earlier, there are some positive signs, there are some negative signs. Industrial production in July and August, after a long time of negative growth of almost 24 months or more, finally has registered a mild positive growth of 0.2% in the first 2 months of this year. And we see noticeable recovery in sectors like cement, fertilizers, automobiles, and electrical goods. But the problem sectors with very large negative growth rates are petroleum refining, steel, and some other capital goods sectors. There has been a degree of buoyancy in our stock market, although it tends to vary depending upon the security situation. There has been a sovereign credit rating upgrade of Pakistan, and we are beginning to see some positive portfolio inflows. So these are some of the positive signs. But there continue to be a number of negative indicators. As I mentioned earlier, exports continue to decline, and in fact decline more sharply. And that's extremely worrying. And what is particularly significant is that our emerging manufactured exports, the ones which had given us some hope over the last 2-3 years, are the ones which are declining the fastest. The bigger percentage decline in emerging exports as compared to textiles. Private investment is plummeting sharply. We have seen a decline of almost 30% in the import of machinery, and last year there was probably a decline of over 10% in real terms in investment in the manufacturing sector. The private sector has contracted its credit demand, which has fallen to almost 23 billion of retirement of debt in the first 4 months of this fiscal year. Tax revenues remain stagnant, very little positive growth in revenue. The bottom line is the recovery process, or if you like, the process of emerging from the recession remains fragile, and stabilization measures cannot be ignored because there are some very serious, if you like, downside risks. And let me list 5 of them. The first is our ability to implement a larger development program and so on hinges crucially in the short run on the inflow of external funds. Over the next 5 years, Pakistan's balance of payments gap of almost $45 billion is expected to be filled to the extent of 30% or more by the inflows through the Kerry-Luga bill and through Friends of Democratic Pakistan. If either of these flows do not materialize, we will have to find ways of cutting back on imports. Prices of oil have begun to rise. Government has based all its projections for this year on a price of oil at $68.5 per barrel. The price already is almost $10 higher. And for every $10 of higher price, we pay an extra $1 billion in imports. The stagnation in tax revenues has reached a point where in the recent negotiations with the IMF in Dubai, we have agreed that following a review the 31st of December, government of Pakistan may have to go in with some additional taxation. The global recovery is tenuous. As already highlighted by Waqar, unemployment continues to rise, and it's not clear how rapidly we will see growth in world trade in the foreseeable future. Perhaps the biggest downside risk at this point is the heightening of the war on terror. The incidents have been multiplied, and in fact, security levels have reached the point where investor confidence has really probably been fundamentally impaired, and the fact that many of our guests cannot visit Pakistan is an indication of this problem. So the situation is fraught with risks. And one likes to think that Pakistan will somehow or the other emerge successfully from such a situation. It seems to me that over the next 2 years, we have two growth scenarios. One is a growth scenario where we can get back to a growth path of 5 to 6%, which I would classify as the positive scenario, which is based on the following preconditions: a strong global recovery, a fundamental improvement in our security situation, essentially victory in the war in north of Pakistan, followed by a sharp reduction in incidents of terrorism, a beginnings of resolution of the energy shortage that we have faced, continued strong support from the international community, particularly from the Friends of Democratic Pakistan, a successful enhancement in the tax to GDP ratio, and a more expansionary monetary policy. In the absence of some of these factors, I am constrained to believe that we will continue to move along at growth rates of between 2 to 3%. What should businesses do in this environment? And that's the last part of my statement. The first is tackling the energy shortage. I think we have to have the recognition that particularly gas load shedding is here to stay. We may gradually surmount the problem with power, but the gas shortage is structural in character and is likely to persist for a long, long time. And therefore, companies need to explore possibilities, I'm afraid, of self-generation, particularly of power. Interestingly, the survey that the Institute carried out of industrial units in Faisalabad, Lahore, Karachi, and Sialkot showed that 75% of the larger industrial units of Pakistan already have self-generation. So they have insulated themselves. The real brunt of the load shedding has fallen on our small-scale sector, which has been badly hit by power load shedding. The second area which I have a feeling companies are already looking at is what I call corporate deleveraging. What we saw between 2004 and 2007, when interest rates fell sharply to low single-digit rates, companies were able to access clearly cheap credit from the banking system and became, if you like, over-geared or over-leveraged. And in fact, the gearing ratio of the corporate sector rose from about 20% to over 30% during this prime period of low interest rates. Clearly, there was an imbalance which had emerged in the capital structure